Yeah, the guy wrote Black Swan and he did Anti-Fragile as well. He was saying he's never seen a shortage not followed by a glut, but he's seen a glut not followed by a shortage. And I think a shortage kind of, a bit over-exaggerated in Q1, early Q1, took the market by surprise, and product cracks, absolutely roofing. It meant that when refineries were coming back online in the US and when we were getting more utilization and I guess crude demand was easing, we really aggressively form a glut. Hi everyone, welcome to another market episode of World of Oil Derivatives. I'm Greg Newman, Group Chief Executive on its Capital Group, having survived the presenter coup from James Todd last week, who did a great job. And I'm joined today with the classic team, James Brodie, Vincent Wu and Martha Dowding. So to get straight into it, Vincent, you want to give us a summary?
Sure thing. So it's been a week of consolidation for crude futures. Brent reached highs of $87.70 per barrel last week, but since then it has come off slightly to around $85 to $86 levels. So still quite bullish sentiment. However, it seemed that prices reached a bit of a resistance last week, people looking to take profit. However, the CFTC data did confirm that over the past week, money managers have been extremely bullish in both Brent and WTI futures, adding around 100 million barrels of length, which is a 25% week-on-week increase. So that is quite substantial. There is a lot of length in the market right now. It seems that positioning might be actually right at current levels, oversaturated to the long side, especially with longs and Brent futures almost at a 2-year high. But in terms of the news and headlines, it's been very much geopolitical driven as well as macro driven. So you had things like Swiss National Bank rate cut last week. That was a surprising one. There is a lot of interest in interest rates from major central banks to come down during by the time summer comes around. But at the same time, there's also some supply concerns, continued geopolitical risk premium, tit for tat attacks between Russia and Ukraine on energy infrastructure, on refineries. You had the tragic attack on the tragic tragedy in Moscow's Crocus City concert hall last weekend, with 137 confirmed killed, and attacks have been claimed by ISIS. And also at the same time, you had a UN Security Council calling for a immediate ceasefire in Gaza. The resolution has passed. That was the first time since October. This would be a temporary ceasefire to last for the duration of Ramadan. So still very bullish sentiment. Market seems to be in balance at these high levels, but geopolitical risk premium continues.
Yeah, so I think digging into that a little bit more, I've got a good graph here for the changes that you're talking about in the positioning. The fund managers getting very long, and they tend to react to obviously more macro themes. And I think last week you guys were discussing the SPR kind of shit show there with the announcement. I would argue that that was probably a big driver of fund managers entering positions. It's just a very macro signal as bullish, even if it turns out to not be exactly true. It's just signaling at least that there's more buying to come when we already have the kind of conditions for a tighter market. I love looking at these graphs because you can decipher kind of who's buying and selling from the industry versus the fund managers, and every buyer there needs to be a seller. So I think to your point about a lot of length in the market, I think the producer merchant section being the oil traders in the industry, they've definitely been long this year. I think it's hard to argue they haven't been. I think they've been reacting to underlying strong signals in crude before the kind of wider macro, but it looks like the liquidity was kind of given to the fund managers from these players, right? And I think it's something to be said about end users also piling in, but clearly in this section, as I say, if they're the majority of the sell flow, then it's got to be kind of oil traders actually taking profit and liking kind of the current levels having been stagnant for so long. Only like at a $4 or $5 per barrel rally, But the thing is, when these things happen, they're great liquidity events for longs, right? You're waiting around, you've got huge positions. Something material happens where there's a shift in fund positioning. It's a good time to use that liquidity to take profit and not move the market, and not only not move the market, but actually benefit accordingly. So that would kind of make sense strategically. The WTI on the other side, barely any producer merchant activity in all funds. And I think, all funds on the buy side, and kind of just the selling kind of either taken from Brent or just like kind of evenly positioned across all the other categories. So yeah, I think the US generally have kind of a macro bull sentiment, and it's kind of what you said. But I think the talk is still, if you do speak to fund managers out of the US, the talk is still like, well, we are not really seeing much of a return in the outright price. Maybe it's changed as of literally last week, but it was still all about, maybe we'll look at products this year. Maybe we're looking for more of a return in kind of the underlying things that has made them kind of ignore the flat price until now. So a big rush in kind of makes sense. And then I think the US stats are starting to head more towards the bull side as well, right?
Yes, so last week's EIA stats, we also saw another week where there was draws in both crude, Cushing and gasoline inventories. Yeah. And indeed, US gasoline inventories have been at the lowest time of the year since 2014, which is quite supportive of gasoline cracks. You had a combination of potentially higher demand as well as certain particular refinery outages, which this would also imply stronger demand for crude as refiners try to rebuild stocks and try to normalize them. And of course, you have summer driving season. Yeah,
that's not too far away. Getting into Q2 now, which is kind of trading more towards summer contracts. So James, what are we thinking? Like the macro situation week on week, and is it contributing to this kind of macro bull sentiment in WTI in particular, and the fund managers? Do you think it's all linked? Do you think people are more bullish these days generally?
Well, what we're seeing last week was an interesting week with the central banks, because we've had at least 9 months of central banks talking about keeping rates higher for longer. And then last week we saw, as Vincent mentioned earlier, the Swiss National Bank surprised by cutting rates. And we also had the Bank of England coming out highlighting that they expect inflation to be below 2% in the second quarter of this year. So the market's suddenly pricing cuts sooner. And the market's looking at April possibly for the ECB. In fact, one ECB member, Sis Kluna, came out saying you can't exclude an April rate cut, and April is not impossible or even improbable.
This is quite a big swing, right? I mean, we've been tracking this very closely week in, week out, and we went from looking very unlikely to be cuts, and actually the reality being like stagnant inflation, or at least robust inflation, and it being quite tricky to get out of this situation, to all of a sudden EU talking about cuts, and maybe even the US, and it's maybe something to do with elections, I guess. But it was quite compelling that they were saying that along with, well, look, we're 2% inflation, and that's a huge deal. That's
absolutely, and we're in recession.
Yeah. But that's quite a ballsy thing to say. 2% inflation is coming up because as we're getting higher energy prices.
Exactly.
Yeah,
and especially as inflation has got so high and it humbled the central banks so badly.
So it could be a return of that again. They could get stung a second time being complacent on energy prices.
And the other interesting point from the central banks was the Fed on Wednesday night. We keep saying the US economy is the economy that's still ticking along, still showing good growth. The Fed revised up slightly their GDP estimates for the year. They revised up slightly their inflation estimates for the year, but they kept their dot plot where the Fed expect interest rates to be at the end of the year. They kept it at 3 cuts. So the market saw this as dovish. The economy is strong, but the central bank is still looking to potentially cut 3 times this year. So the bond market's rallied. So the OAS curve is pricing more aggressive cuts. So again, this might be stimulatory for oil price. Yeah. If the Fed are ready to cut rates before the economy moves into recession, then that's potentially good for economic growth.
And again, being a bit more simplistic about it, you've got to put your money somewhere, and your allocations. And if there is the threat of energy prices kind of on their way up again, you've heard these SPR announcements in the US economy, it feels like it's logical for fund managers to starting to be focusing on outright oil prices again. I mean, that just seems logical to me.
Absolutely. In commodities in general, we see this morning gold is trading back up at 21.90, just below its all-time highs. So gold uptrend has kicked off again.
And we've started to talk much more internally. I mean, we've got a new guy, Jorge, who loves talking down the US dollar. He thinks it's over for them. But in general, is that coming into play? Because people still seem to be very bullish the dollar. I mean, how are you looking at it from a debt perspective and the dollar perspective?
If anything, the dollar's strengthening on the fact that the economy is strong, and the euro, which is about 55% of the dollar index, is going to have to cut sooner and harder.
Right.
Bank of England too. So the last few weeks we've seen some dollar strength, which I expect to continue because that's the economy that's still ticking along.
Yeah, it's all very US kind of bullish macro focused now, but it's so topsy-turvy because a lot of the strength was coming from Europe unexpectedly at the beginning of this year, and we had underlying crude markets like on fire, really strong crude differentials indicating the physical market really strong. But Martha, that's kind of completely reversed, right?
Yeah, so the dated Brent physical market in the North Sea has had a pretty terrible time recently. I think we said a couple of weeks ago we saw that reversal, players stopping out of position, spooking the market. No one wanted to kind of have these barrels, and we haven't really seen that improve. We're seeing an ongoing contango in the front. We're at about minus 30 cents a barrel levels for the early April loading cargoes, which are not, no one wants to buy them at all. They're struggling to clear. There's some better support seen later down the curve, as we said last time, to kind of expect to see that. So in May structure, but I mean, April is maintenance cargoes, and we're not really expecting this to get any better anytime soon. Yeah,
this is an interesting one for me because the market never ceases to prove that it's inefficient all the time. In other words, people love to say, particularly in the oil market, that seasonality is priced in, and we get it proven every year that's not the case, right? So you're looking at maybe too early pricing in seasonal patterns, and we get a big reversal the other way as people stop out on a mark-to-market loss. But in this situation, we had an incredibly strong prompt market kind of in Q1, and there were actually the beginning of the positioning was actually to be bearish the market because of maintenance. People didn't believe with the current environment that if you added European refinery maintenance that the demand would be there for crude, and therefore crude would sell off, and there was a lot of shorts in the market off the back of that. We then had a very tight market, then everyone gets excited the other way, forgetting about the seasonal kind of weakness, and we've got a refinery margin type trader here, James Anderson, and he was sticking to that. You actually have to wait until maintenance is starting to trade, the barrels that trade in maintenance starting to trade, in order to see the market reflect this. And he was bang on. We've kind of collapsed all the way down when we would have said it's looking as tight could be. And as I say, it's always just a really interesting proposition to not believe in the efficient market hypothesis. I don't think anyone actually believes that, but is in like so much so. Is being proven, particularly with the oil market. So what about refinery margins, Martha? Like as the crude markets have kind of, well, at least in Europe, have reversed, we've still got a strong outright price. But now the tightness we were seeing in the underlying physical in Europe's reversed. US looking pretty strong, okay. And the refinery, like the product market is doing what?
Well, the refinery margin has seen a decrease week on week in all three regions, so Europe, Asia and America, and all of this is driven by distillates being the biggest loser in all regions, so gasoil, syngas oil and heating oil. So there's little spring demand in Europe especially, and that's weighing heavy on the values. Looking at the freight between the different regions, at the moment the freight is very high to move anything from Asia to Europe, so that's bringing down the prices in Asia, but also not supporting the prices in Europe because that's getting more supply from the Middle East. So it's just pretty rubbish all around. US have got a weak demand sentiment. The stats were 0.624 million barrel build. Heating oil have been really, really poor as well. But, we may be seeing a change. It's hard to say because we've been seeing the gas oil crack hit this technical floor before, which it's just passed this morning. We're down past $24 a barrel. And so it's kind of hard to call whether that's going to be. We thought that maybe it would be better risk reward to be longing this, but it's just a bit more tricky to call now. We might be seeing a bit better demand coming soon, and in anticipation of that demand, people are saying that's going to kind of time at the same time that freight softens, but both things are kind of a bit of a call there. And also with the discussions that I think we'll be having a minute later on with the US telling Ukraine to stop drone striking the Russian refineries, that could maybe withdraw some of the geopolitical risk premium that I think has been especially impactful in European gas oil. But I mean, you could say that that's kind of pushed into the selling, that people are expecting this to kind of stop. They could be running out of range in the drones or just running out of places to strike. So yeah, I think it's really, really hard to call.
Well, we need to remember that the market's playing out the trader's narrative, and ultimately the trader's narrative, again, looking at Q1 as a whole, has been pricing in outages from refiners, refinery fires, refinery outages in the US, generally a capacity problem, a utilization problem. And meanwhile, we have an undersupply of crude. That's been the narrative. And so the product margins relative to crude, the product cracks, have been massively performing this year, probably too early, right? So we've been reflecting this sentiment of this happening. And remember, we've got to remember how we were thinking as well, living and breathing it, saying, look, this looks very strong. It's going to be very supportive for crude. And it kind of has been. But then we also made the point about it potentially, the demand really not being there for what the product cracks are suggesting in terms of the price in the forward market. So we've got a situation where that's kind of proving, diesel is a great indicator of just general macro oil demand, and that having a really weak time and coming off across the board, whilst refinery maintenance is weakening the crude market, is indicative of like maybe the market got a bit too overexcited, and in the prompt at least, it's just not living up to the hype, essentially. And so now you've got an overly long market that's in a bit of trouble and having to unravel all these positions that were like exuberantly put on in the first place. Having said that, it's a situation of people focusing on where they were focusing, and I think that Q3 is still the main danger area and the main area that people believe it's going to perform. And I would argue if anyone has length in Q2, kind of the bigger traders, they'll probably be rolling that to Q3 rather than stopping out of position. So more and more pressure on Q2 versus Q3 time spreads and product cracks would make sense. And even more so as a crack roll as we kind of get out of maintenance and maybe we pick up in demand in crude. That should be almost like a rebalancing. But I think we need to keep an eye on this because, it's a Nicholas Taleb, is that how do you say it? Nicholas?
Oh, yeah. The Black Swan.
Yeah, the guy who wrote Black Swan, and he did Anti-Fragile as well. He was saying he's never seen a shortage not followed by a glut, but he's seen a glut not followed by a shortage. And I think a shortage kind of, a bit over-exaggerated in Q1, early Q1, took the market by surprise, and product cracks, absolutely roofing. It meant that when refineries were coming back online in the US and when we were getting more utilization and I guess crude demand was easing, we really aggressively form a glut. And that's probably not too surprising and given an indication that, that demand probably isn't there. And as James was saying, we are in recession in Europe, right, and UK. So it's all kind of logical. So I think that's probably the conclusion of that, bearish Q2 versus Q3. And what about gasoline?
Gasoline, that demand story isn't quite the same. We're seeing the implied demand in the States still being really strong. We've seen, 7 consecutive weeks of draws now. And RINs, they're not still rallying, but they're holding their strength really well, which is kind of helping the levels stay so solid. If you just look at the price graph, it's been incredibly stationary. Players are still keen to own summer structure. There's been decent bidding in some summer spreads, but there's been a few days where it's been fairly thin in the market. We've seen maybe news of some more RINs coming in the future, but I think it's very hard to say with that kind of stuff because the developments are so far in the future for like the biofuel and stuff, so it's hard to call RINs that early. So I think this is maybe a bit more of a financial correction. Rubber's failing to see anything really happening. It was been kind of range bound around 28, but then it pushed below it again this morning. So it's fundamentally, it is looking really strong. I know the Gulf Coast PAD 3 gasoline stocks are at their lowest since March 2021, and the lowest they've only been this low 3 times before, and these stocks have fallen for 9 weeks. PAD 3, everything's up and running again now. I know the Port Arthur refinery was down for a while. It is running, but I have heard there may be curtailing production, which is always a bit of a hot topic. The Port Arthur refinery, owned by Saudi Aramco, So, there's all the conspiracy. They're driving up gasoline prices for election year. It's a really interesting thing to be looking at, but also I'm not sure how reputable those reports are of the production curtailing, but it is legally all up and running again.
Well, it
after
matters
the fire.
what people believe, right?
Yeah,
And
definitely.
that's how they put their positioning. So that's actually very, very interesting. I agree. And I guess definitely something to watch. So as we potentially continue to weaken in distillates and maybe the wider refinery product margins in Q2, if gasoline holds up, it's actually a pretty incredibly bullish sign coming out of Q2 and into summer, right? As we get the summer demand, that's quite supportive. So that'll be a great, very interesting one to watch.
And we're just seeing good, like fundamentally, we're seeing that there's lots of incentives for blending right now. Ethanol's really, really cheap. Ethanol's only been this cheap relative to RBOB during the Ukraine war. So a while ago, which might incentivize blending. We've seen the refinery, the unit margins for like the beginning of the year really, really strong in the US Gulf Coast, which could, again, it's been a few months since that, so we might see the results of that coming in now. I think it's a really interesting state.
Yeah, this is really good work, because actually what this tells me is, as you say, if curtailing production, and when you're trying to basically do what you can to make the gasoline market tight. People who are bullish are buying on the paper side, on the forward market. You've got refiners, maybe being careful about what they produce. All the things you're saying, maybe maximizing exports where they can to other regions, things like that. An indication that that's happening is when things like, as you say, the ethanol blending economics get very attractive. Because if it's not in line with fundamentals and it's kind of held to above where the actual demand levels are, then it opens up arbitrage from other areas, because the ethanol market wouldn't be as weak if the demand was genuinely that strong. Then you'd expect kind of ethanol to be the opposite, right? It'd be very supported by
especially
RBOB.
during E15 season. We're about to switch to E10 for summer, but I mean, might still have some improvement for blending. They still need some ethanol in it,
But I think the indication is, as you say, like it's maybe there's a lot of people who want this price to be higher at the moment. So I think that's not beyond the realms of doubt that there's production being held back and these kind of things. So that's a really interesting one to look at. All right. So from a more macroeconomic kind of point of view, what about Googling oil? Vincent, do you want to?
Sure. Yeah, I can go through this one. So you had a few headlines. More on the geopolitical side. So again, Ukraine. It was an interesting one. Ukraine has developed 15 kinds of long-range strike drone and has sorted them against Russia's oil industry. So in continuation with all of the past few weeks, topics about Russia and Ukraine going up against each other's energy infrastructure as military strategy, tactics of war, except this time, Ukraine. It seems that Ukraine has been developing their own long-range strike drone, so deep within Russian territory. Although it is acknowledged that just by itself it won't do much to affect refinery production, as in it's more of a logistical nightmare rather than shutting down their oil industry. The goal is to sow discontent within the populace and also distract Russia from the actual from their tactics on the battlefield. And of course these are I suppose you could say there's a lot of small things here and there to annoy Russia, to distract them and make them kind of focus away from the battlefield.
I think the talk in the industry is more towards 500 miles from the front line. It's not very believable that this is drone technology. So this kind of article coming out would make sense, right? It's like, we need to justify how they're flying 500 miles. They've got this great tech. Now, where did that tech come from? And why has everyone not got it? And I think it's more likely that it's happening from within Russia. And it's probably showing signs that there's maybe some growing discontent. And that's at least how people are viewing it. It has to be coming from within Russia for it to be so effective. But, again, this is another conspiracy theory, so maybe that's the title of our podcast. But you have to kind of weigh it all up. It's what we do know, though, is that these strikes were an initial just kind of little bit interesting anecdotally to probably going to continue to drive the market or be very interesting and needs to be accounted for the market, again, especially going into summer. So yeah, we need to keep tracking it. And what else? You've got the US actually urging Ukraine to stop attacking those refineries.
Yes. So again, well, it's less so of a conspiracy theory, but it's related to election season.
Yeah.
Of course, by reducing Russian production, it drives up oil prices, global energy prices as well. And of course, during the election season, that's not what the Biden administration wants. And as well as they're also fearing further retaliation from Moscow. So it's interesting to see the geopolitical dynamics at play here.
And lastly, we've got a clip from The Telegraph who say that the USA is now producing more oil and gas than ever, and they say that that's a triumph. So just in terms of numbers, in September 23, they pumped over 13.247 million barrels a day, and I mean, they've just been breaking records again and again. This was the highest oil production ever by a single nation in a single month back in September. And December broke the record again. The exact figure's not clear. And in Q1, it's likely that the November record was surpassed again as producers enhance their production techniques. This is basically saying, yeah, they've got all of this energy security, but of course, it's not quite that simple. The shale they're getting out needs to be blended with a lot of the time like Canadian oil to get the heavier products, like to get heating oil and stuff that needs to be used for harvesting and then everything really. And it also, you need to keep an eye on like refineries and utilization. As I mentioned before, you can't really have energy security if another national company owns your biggest refinery in the country, because that's not the US. And just with like how the country is shaped, you're always going to have to get some imports because of like the Jones Act that we actually mentioned last week, weirdly. But yeah, really interesting and just amazing numbers, record breaking.
Yeah, I think that's what I found interesting about this SPR announcement last week. I forgot how you say her name.
Jennifer Granholm.
Granholm. She, I mean, yeah, I think kind of went too far maybe, but I think at least the clear message I was getting was we are committing to short-term oil because we understand the importance of it from an energy security perspective, but we're making such great strides with renewables that it will eventually even out. So it's trying to appease everyone, right? Saying like we're still pushing ahead with renewables, but for the anti kind of or pro oil guys, we're supporting you. And then it was also saying you can convert all these oil and gas licenses for free, no administration, into geothermal licenses. So trying to say, come along on this ride, we're all in it together. And it was just a bit haphazard. But either way, I think it's a clear signal, especially with the bigger companies having consolidated so much of the US production this year and end of last year, that oil is going to flow and continue to flow in the US. And I think even the LNG export ban, saying that's going to be in the rearview mirror, I think they're saying US fossil fuel industry is open for business, and in whatever administration it is, which I thought was a pretty big statement actually, if you think about it. Even though it's masked, well, it was caveated with maintaining that push for renewables. I think the clear sign is they want to continue to be leaders. So we have to expect that production to keep going up as we go on. And I think talks about it leveling off, like there always are kind of misguided. But moving forward to our forward point of view, trade idea. Who's doing that?
I'm doing that one. So for all the talk about gasoline, my idea would be actually to go short in the summer crack.
Okay.
So summer short in the Q3 EBOB crack for a couple of reasons.
The Widowmaker. It's called the Widowmaker.
The Widowmaker. Yeah. The Widowmaker. So cracks have reached resistance at...
you don't have a wife, so it's fine, right?
Not yet.
Okay,
could be husband.
Yeah, could be husband. Yeah, I don't want to judge. Yeah, go on.
No. So I think looking at the charts, it's cracks have been performing quite well. Our sentiment is still quite bullish for the summer ahead. However, currently we think that it seems that strength has been relatively priced in. But it's very interesting looking at what data we have on the EBOB crack on our COT dashboard. So of course you have the market building up a lot of length in the cracks. However, the market trading split in the past week has been indicating that there's been a lot of selling over the past week, especially in the Q3, Q4 tenors. Meanwhile, open interest, July, August, September, has plateaued since February, indicating that a lot of those might actually be somewhat profit-taking flows. As well as that, on our counterparty data, it's suggesting that both physical and financial players have been selling the contract over the past month. So you have refiners notably flipping from positive to some from positive to negative net positioning. They're more on the sell side, as well as have majors NOCs and also funds coming in going short in the crack. So all of these have indicated that potentially, at least temporarily, the crack may have reached a temporary high, and we might see, if there was more bearish headlines, for example, the EIA stats showing a build, or we also have the Whiting Refinery coming back online as well. That created that was one of the main drivers of gasoline strength in January. So with all of these factors in mind, we think there could be a temporary fall in the EBOB cracks as players look to take profit, more new people coming in.
I think what you're essentially suggesting is this is if there's going to be a surprise collapse in product cracks and gasoline cracks, the Q3 is the most vulnerable because that's where everyone's long. And if there's stop outs, it could be very, very aggressive. I guess that is logical from that point of view. And if you've got that resistance point in 19 and the volatility is quite low and you've already got quite a positioned market, then I wouldn't call it safe, but it's a relatively short term. If you can get good entry level just below 19, for example, it's quite obvious where you put your stop, right? It's like just above the resistance level, and you just try and keep yourself nimble. But if you do kind of catch and move downwards, you can be scaling in with the knowledge that a long market's left holding the baby, and if the momentum is heading south in Q2 and it's dragging the whole forward curve lower, you could get some panicking, and the market can stay irrational longer than it can solvent type thing. So I see your point. I think you would allocate a low amount of risk to that one, but that doesn't mean you're in that trade and you start to capture and move downwards and scaling into it. It could become quite a good trade quite quickly. So no, it's an interesting one. It's definitely a contrarian one, but no, I can definitely see the logic. And in terms of just our kind of macro view as well, though, from a trade idea perspective, I mean, what are we thinking? Brent spreads, Brent time spreads, and Brent outright price.
In our Brent forecast on Monday, I believe we said around 86 to 87. The market's kind of consolidating, might be able to build up a bit more strength coming into the end of the week. Seems just like a kind of a financial correction leveling off. The market wants to be long, and it doesn't seem to really be paying that much attention to the weak physical market.
Mm-hmm.
It wasn't last week. I don't know why it would this week.
Mm.
And the refinery rates are still high. So that's it's not like we've seen a huge drop off there, just like $1 was about $1 or so. So I think we're very cautiously bullish in the flat price.
Okay, and the time spreads, have had a pretty serious correction, and I think it looks like, the physical crude markets had pretty serious correction, but if you look at the Brent time spreads, they're still relatively elevated, and I think the prompt fly. So you've got May, June versus June, July Brent is kind of negative 10-ish cents, but the outright physical, diff level. The time spread 60 cents relating to an expiry of around 50 odd cents on the physical differential. So that's still pretty high. That's still indicating a pretty strong market. But of course, it's May loading barrels. So people might be very interested in May loading barrels, certainly at a certain price, because we're coming out of maintenance. There tends to be some good Chinese demand around May loading. But of course, China have had their issues this year, and it might not be as straightforward as that this year. So again, it's going to be an interesting one. I would expect there to be interest for actually the physical kind of post-expiry maybe for May, assuming it kind of gets weaker. But if it's going to stay at these levels, it's quite a dicey trade. So I would say that where the momentum is, and we've only got a few days to expire anyway, I would say kind of want to stay out the front spread. And if you're going to be long, it's positioning with the flies, not the outright spreads. Okay, and we did a poll last week as usual, and this was what levels will the SPR be by 2024 election? I guess the US election we were referring to, and most people think it will be more than now. So they are going to add. They're not going to. It wasn't a bluff. But a fair amount of people, 38% people, thought it'd be less than what it is now, which I guess could be a retaliatory measure if prices start getting quite a bit higher. So yeah, that's kind of a bit up in the air. Okay, and I guess, James, just to finish off, like what we should be looking out for data-wise on the macroeconomic side.
Again, Greg, it's a pretty quiet week data-wise. We have US consumer confidence today, and then on Friday we have PCE inflation data, which is important actually because it's the Fed's favourite inflation measure.
Okay, very important then. Okay, so that's definitely one. And do you think there's probably going to be a fair amount of announcements, as always, right, around these kind of cuts and...
Yeah, we have continued central bank rhetoric.
Yeah.
Speakers, and again, the key is where the bond market direction it takes from here. But at the moment, people are back buying bonds. Again, the market keeps being caught offside. In January, the market was pricing 6 cuts. It went all the way back to 3 cuts last week. Now we're starting to price 4 cuts in the US and more aggressive cuts at the front of the curve. So the bond market, or more specifically the overnight index swap, is worth keeping an eye on.
Okay. So basically bullish dollar though. Bullish dollar against the EU, against...
Definitely against the pound as well.
Okay.
The only other interesting, actually, currency-wise, the Chinese intervened yesterday to support their currency. Really, a weaker Chinese yuan will help their currency, but what they don't want is the currency to weaken too quickly. So they've been in to support that, and there's continued talk from the Bank of Japan about possible intervention if the yen weakens against the dollar, but we're seeing that's stuck pretty rigidly about 151, I think the level is there. But really, I think dollar strength going forward, we'll continue to see more of that.
I think we have to summarise macro and oil markets is topsy-turvy, different indications in different places. I think we'll sign it off there. Thanks very much, viewers and listeners, and please remember to like and subscribe. We're really enjoying all the attention we've been getting recently, and people are becoming more interactive with us, and it's really great to see. So please keep it up, and see you again next week.